Hey guys, it's Wayne Scully here with W. Scully CPAPC, business and tax strategist. My focus is on providing solutions to landlords, flippers, and real estate pros in the New York tri-state area. My firm offers tax compliance, business consulting, and high-value tax planning strategies to save you thousands of dollars. Now, the title of my video today is, hey, did you know the IRS owes you $20,000? Well, I know you're thinking it sounds too good to be true. How? Why? Well, I thought so too. And maybe for some people it is not true, but for others it's definitely true. So if you own rental real estate, you could be walking away from thousands of dollars in tax breaks. Yeah, I said $1,000 in tax breaks. Don't thank me though. Thank this little thing called depreciation and cost segregation too. Okay, so most property owners, they know of depreciating their property either 27.5 years if you're a residential property owner, or if you're a commercial property owner, it's 39.5 years, right? But actually, you can actually depreciate parts of your home or property, whether it be commercial, residential, over short periods of time. It could be 5 years, it could be 7 years, 15 years, 20 years. It runs the gamut. Well, what does this mean? This means you can accelerate your depreciation deduction. And yeah, you ask me how. Well, you get to recoup the cost of the purchase in bigger chunks over a shorter period of time. So let's say you have $100,000 purchase, right? For that property, or parts of that property. Instead of taking that $100,000 over 27 years, it will take you 27 years, right, to get that back. Now you can potentially, get $20,000 as a depreciation deduction. And if you're not capped at the $25,000 passive activity rule, or by that rule, then you get to take that 100% to offset other income. But I don't want to go into that too much. My point being, though, that you can get that money, right? Keep that money. And it's all about the time value of money, right? If you're able to keep more of your money today and invest it today, right? You can then put that money into other parts of your real estate, or buy other properties or some other venture, or if you invest at a nominal rate, you'll be better off than giving it to the IRS, right? So I'm saying time value concept of money. It means you can benefit from your money at a faster rate, or benefit from your money now in terms of today's dollars and what's happening in the economy today, versus waiting later on when the money would be subject to the forces of inflation. So you don't want that to happen, right? So get your money now, invest it now, so you can see the value of that money as time goes by. So how do we do this, right? As I mentioned before, cost segregation. Cost segregation study is key to this, right? But wait, I should tell you that there are issues that you need to be aware of before you go do a cost segregation study, right? And here are a couple of considerations you want to think of. The cost of the study. It could be between a couple of $100 to tens of thousands of dollars to get this done, right? So you have to really be careful, and whether or not you want to venture there, unless you do what's called a cost benefit analysis, CBA, right? If you do a cost benefit analysis and the numbers work, then it makes sense to spend $20,000, right? If you get a tax benefit of $100,000 and you spend 20, it makes sense. And remember, $20,000 not just for 1 year, right? For several years, right? So there's also the Section 31 issue, wherein parts of the property, the parts that you're depreciating over a shorter period of time, may not qualify in the exchange, right? So I don't want to go into 1031 exchange, what that's about, but essentially it allows you to defer any gain from the sale of a property by using an intermediary through which you'll buy another property. So it gets a little bit technical here. I don't want to go too much into that, but the point I'm trying to make is that some parts, if you use the cost segregation process or steps, you would not be able to depreciate, or shouldn't depreciate, I'm sorry. You would not be able to qualify those parts of the property for this 1031 exchange. And then the ordinary gain on the sale, right? Typically, typically you have a capital gain, right, and at lower rates. But if you use the cost segregation process, some of those would not some of those parts of the property you're depreciating would not qualify for those rates. You'd have to take ordinary gains, which are taxed differently, right? Some instances, capital gains are at zero. The ordinary gains are never at zero. They're at ordinary tax rates. So there you go, folks. I've only scratched the surface on this, by the way. So there's more to it. Be glad to have a conversation with you on this and another topic that you may have, another issue that you may have come across or need clarification on. So if that's the case, give me a call. My name is Wayne Scully. I'm with W. Scully CPAPC, always working around the clock to save you a chock full of money, stress, and time. Make an appointment by visiting my website, www.wscullycpa.com. Again, www.wscullycpa.com, or call me toll free, 855-254-1892. Please comment, like, and share this video. If you didn't like it, I'm sure there's some useful information that somebody would like to hear. So feel free to share it anyway. And thank you guys, and catch you next time.